Oil prices are down today, but they've been on a tear in the past month. The sector's up almost 14%. Joining us is Kyle Bass, founder and chief investment officer at Heyman Capital Management. Welcome back, Kyle. Nice to see you.
Good to see you too, Sarah. Happy New Year.
Happy New Year. So what are your thoughts on whether this Happy New Year for oil investors can continue? Pretty terrific start to the year, especially given the outperformance last year and the wobble in the market.
Yeah, I think there's a huge mismatch, I think, in policy and reality. And when you look at the reality of hydrocarbon demand, of oil demand over the next, call it 20 years to 2040, we think it's just about going to be right where it is today, although it's going to move higher before it moves back to this level. And for the last 6-7 years, we've basically been pulling CapEx out of the oil patch because we so desperately want to immediately switch to alternative energy, right? We all want wind and solar and cheap, clean power to run our country, or the world. The problem is you can't just turn off hydrocarbons. It takes 40 or 50 years to change fuel sources. So it's a long way of saying, I think you should buckle your seatbelts. I think we could see well north of $100 this year on the front end. And I mean that because the same situation will apply that took oil below zero will apply on the upside, i.e. when we reopen, the Omicron variant will peak sometime in late January, and we will get the world kind of reopened sometime mid-year, and demand's going to go right back to its highs. And you can't just flip on an oil well. You can't just turn it on, and there's not enough money drilling. In fact, private equity's pulling back, public markets are pulling back. The only people funding the oil patch are family offices. We're going to see really high prices very soon, which is not going to be good for anyone.
So, yeah, no, and the administration is going to hate it, especially. They've been trying to bring down the prices from here. So you're looking at WTI prices going over 100? And
I think well over 100.
So, and how would you buy the oil stocks? How do you?
Yeah, I mean, look, if you have the capacity, you want to be out there with proper geologists and smaller companies that are actually able to fund CapEx. There's so few people out there funding CapEx, but yeah, you want to buy oil equities, you want to buy front-end oil futures. I think you're going to see again, if we reopen, I think you're going to see numbers that people aren't ready for.
Carl, in terms of China, which we know you're a perma bear on, I'm just interested in your take on the extent to which stocks there could still rally this year, as they have to start the year, given underperformance and given at least the news changing tone as it relates to their economy from very negative tone late last year and very early this year.
Well, number one, Wilfred, I would disagree with you. I think I'm a China realist and not a China bear.
That's what all bears say.
That could be the same thing. That could be the same thing.
It's
you might
going
be right,
to be the
but you're
same
still
thing.
bearish.
Yeah, look, I think about a third of China's economy is driven by the real estate markets, and what she figured out is with their money printing about on the same scale ours is as a percentage of the economy. And the rampant speculation in real estate in China, prices got so high that you saw the average birth rate of the Chinese woman went down to 1.2. You need a birth rate of 2.1 just to sustain the population. So you have an aggressive population decline because the Chinese families, the men can't afford to buy the homes because they're 20 and 30 times their average annual income. And so they're living in their parents' basements and not having kids. And they finally realized that this crackdown isn't about a market crackdown necessarily. It might be a little about a billionaire crackdown and the corruption crackdown in China, which will happen ad infinitum. But I think it's really important to note that Xi needs real estate prices down, and he needs them to stay down. People that are kind of betting on a bounce, I think that's kind of a fool's game, especially knowing that Chinese equities, again, don't submit themselves to Western audits. And then how does anyone discount Xi Jinping risk? I mean, we saw what happened last year. You know, fool me once, but you're not going to fool me twice. I think people investing in Chinese equities are breaching their fiduciary duties to their investors.